In a world of opportunity and uncertainty, the pursuit of financial success can lead even the savviest of investors down treacherous paths. Welcome to a thrilling expedition into the gripping realm of finance, where fortunes are made and lost in the blink of an eye. In this captivating video, we'll be unraveling the shocking secrets concealed within the shadowy world of investments. Join us as we expose the biggest mistakes that have left even the mightiest tycoons shattered and penniless. But before we dive right in, be sure to do good by hitting the like button and subscribing to the channel. Done that? Now, let's get back to it. Number 10. Lack of research. Delving into investments without thorough research can lead to unfavorable outcomes. Imagine navigating a maze blindfolded. Market research becomes the compass for successful business development. It acts as a guiding light for startups, new product launches, and rebranding endeavors. Neglecting this crucial step means missing out on valuable opportunities that could fuel long-term success. Savvy business owners grasp the pulse of their markets, competitors, and customers' needs. They gather essential information to gain a competitive edge. It's not just about knowing when and where people buy products. It's about understanding the underlying reasons behind their choices. By neglecting market research, a business falls prey to indecision, inaction, fear of risk or truth, and a myriad of overwhelming options that lead to paralysis. Remember, not every product suits every person. When launching a new product, effective market research unveils the market's true potential and identifies the most promising customers. Crafting specific survey questions enables better positioning of the new product or service, increasing the chances of sales success. Number 9. Emotional investing. Emotional investing, a common pitfall for many investors, can be one of the biggest mistakes that you'll ever make. When emotions take the driver's seat, rational decision-making goes out the window. Fear and greed become the navigators, leading to poor investment choices. Picture this. The market plunges, panic sets in, and you sell all your stocks at a loss driven by fear. Or imagine the opposite scenario. The market is booming, and you jump on the bandwagon, buying stocks at inflated prices due to greed. Emotional investing ignores logic and objective analysis. It overlooks the fundamental principles of investing: patience, diversification, and a long-term perspective. By succumbing to emotions, you miss out on potential gains or expose yourself to unnecessary risks. To avoid emotional investing, keep a level head. Develop and stick to a well-thought-out investment plan irrespective of market fluctuations. Conduct thorough research, seek advice from trusted sources, and never invest more than you can afford to lose. Remember, successful investing is a marathon, not a sprint, and emotions have no place in the driver's seat. Number 8. Lack of diversification. Lack of diversification is one of the biggest mistakes every investor can make. Picture this. You put all your eggs in one basket, hoping for a golden outcome. But what if that basket falls? Without diversification, you are exposed to substantial risks. When you invest, spreading your money across different assets or industries is like building a safety net. It cushions the blow if one investment tanks. Imagine investing solely in technology stocks, and suddenly the tech sector crashes. The end result is that your portfolio will suffer severely. Diversification offers a shield against market volatility. You create a sturdy foundation by allocating your funds across stocks, bonds, real estate, and even commodities. Different asset classes perform differently under varying conditions, helping stabilize your returns. So, why risk everything on a single bet? Diversification reduces the impact of losses, allowing for potential gains elsewhere. Don't be caught off guard by unexpected twists. Embrace diversification, the investor's armor, and let it shield you from financial pitfalls. Number 7. Timing the market. It's tempting to try and predict the perfect moment to buy or sell stocks, but it's a risky game. Timing the market requires accurately predicting market fluctuations, which even seasoned experts struggle with. Many investors fall into the trap of buying when the market is soaring, driven by fear of missing out, only to see prices crash shortly after. Similarly, they may panic and sell during a downturn, missing out on potential rebounds. This approach is fraught with uncertainty and can result in substantial losses. Successful investing is about a long-term perspective, focusing on fundamentals and staying diversified. It's about patience, not trying to outsmart the market. Rather than timing the market, it's wiser to stay invested, maintain a well-balanced portfolio, and ride out the inevitable ups and downs of the market. Remember, time in the market is more important than timing the market. Number 6. Overconfidence. Overconfidence is one of the biggest mistakes every investor makes. It's like wearing rose-tinted glasses that blind us to the risks and pitfalls lurking in the financial world. We believe we can beat the market and make flawless investment decisions when overconfident. But here's the reality. The market is unpredictable and complex. Overconfidence leads us to disregard proper research and due diligence, often resulting in disastrous consequences. We might chase high-flying stocks without understanding their underlying fundamentals or ignore warning signs that suggest a market downturn. Overconfidence also encourages excessive risk-taking. We might put all our eggs in one basket, assuming our investment will always go up. Unfortunately, markets don't always cooperate, and we can lose everything. To avoid this trap, embracing humility as an investor is crucial. Recognize that nobody can accurately predict the future. Diversify your portfolio, conduct thorough research, and remain open to different perspectives. By taming overconfidence, you'll set yourself on a path to make wiser investment decisions and protect your hard-earned money. Number 5. Chasing trends. Trends often captivate our attention, promising quick gains and immense profits. But they can also deceive us, leading to financial downfall. It's like trying to catch a fleeting butterfly with uncertain outcomes. Trends are fickle and unpredictable, changing direction in the blink of an eye. Investors jumping on every bandwagon risk being stranded when the trend fizzles out. Moreover, chasing trends often leads to buying at inflated prices as everyone else is already on board. This leaves little room for potential gains and exposes investors to greater risks. Instead of relying on solid research and analysis, trend chasers succumb to impulsive decisions guided solely by the fear of missing out. To navigate the investment landscape successfully, one must focus on fundamental principles such as understanding the company, its competitive advantage, and its long-term prospects. Patience, discipline, and a diversified portfolio are key to mitigating risks and maximizing returns. So, rather than chasing trends, let's take a step back, evaluate opportunities with caution, and make informed investment decisions that stand the test of time. Number 4. Ignoring risk management. Imagine embarking on a thrilling adventure only to realize you forgot your map and compass. When investors overlook risk management, they expose themselves to potential disasters. They become vulnerable to market fluctuations, economic downturns, and unforeseen circumstances. It's like sailing a ship without checking the weather forecast. Risk management is like a shield, protecting your hard-earned money from unexpected storms. It involves diversifying your investments, setting stop-loss orders, and conducting thorough research. It's like wearing a seatbelt while driving. You hope you won't need it, but it can save your life. Without risk management, investors are akin to gamblers in a casino, relying on luck alone. They might experience temporary gains, but the odds are against them in the long run. It's like playing a game of chance without understanding the rules. So remember, don't disregard risk management. It's your compass, safety net, and key to sustainable success. Take the time to assess and mitigate risks, and you'll navigate the investment landscape with confidence and resilience. Number 3. Neglecting a long-term perspective. Investors sometimes get caught up in short-term thinking, only caring about immediate profits or losses. But they overlook the real secret to wealth, the power of time. They forget about the incredible phenomenon called compounding, which is like a mesmerizing magic trick. Imagine a snowball rolling down a hill, getting bigger and faster with each turn. That's compounding in action. Small gains build upon each other and multiply exponentially over time. It's like planting a seed that grows into a mighty tree. However, this enchanting process requires patience and determination. Successful investors know that time is their greatest ally. Instead of being swayed by every market fluctuation, they embrace the steady rhythm of long-term growth. They understand the potential of enduring investments, allowing their money to flourish and multiply like a garden full of blossoming flowers. So don't be captivated by short-term gains alone. Embrace the power of compounding and let time work its magic, transforming your investments into something truly remarkable. Number 2. Herd mentality. Herd mentality is a captivating yet perilous phenomenon where individuals blindly follow the crowd in investment decisions. It's like a stampede of wild beasts charging forward, driven by fear of being left behind. In finance, this can lead to disastrous outcomes. Investors abandon rationality and rely on others' actions and opinions. They're swayed by prevailing sentiment, driven by fear or greed. Instead of thorough research, they jump on the bandwagon, hoping for success. Herd mentality overlooks individual circumstances, risk tolerance, and long-term goals. It creates a dangerous cycle as everyone chases the same assets, inflating prices. When the tide turns, panic ensues, crashing markets and shattering portfolios. By following the crowd, investors miss undervalued assets and independent decisions. They must cultivate independence, research, diversify, and have a long-term strategy to avoid this. Going against the herd requires courage but leads to sustainable success. In the finance's vast savanna, it's better to be the lion, selecting prey carefully, than the wild beast caught in the herd's frenzy. Number 1. Lack of patience. One of the biggest mistakes every investor makes is a lack of patience. It's like trying to grow a tree overnight. It just doesn't work. Investing requires a calm and patient mindset. When the market is volatile, it's easy to panic and make hasty decisions. But successful investors understand that wealth accumulation takes time. They resist the temptation to buy or sell based on short-term fluctuations. Patience allows investors to ride out market downturns and wait for the right opportunities. It prevents knee-jerk reactions that often result in losses. Warren Buffett, a legendary investor, once said, "The stock market is a device for transferring money from the impatient to the patient." By practicing patience, investors allow their investments to grow steadily over time. They stay focused on their long-term goals and stick to their investment strategy even during turbulent times. Remember, Rome wasn't built in a day, and neither is a well-performing investment portfolio. So embrace patience as a virtue and let time do its magic in growing your wealth. By avoiding these common mistakes and adopting a disciplined approach, investors can improve their chances of achieving their financial goals. But remember, in the world of investing, the greatest mistake is never trying. Therefore, embrace the lessons learned, grow from your missteps, and watch your portfolios soar.